let me answer that in parts. My experience has been that in precious metals bull markets, gold leads. And when gold's momentum attracts the generalist investor into the space, leadership transfers to silver. Whether we're there or not, I don't know. What I do know is you won't need to tell me when it occurred. they're usually pretty dramatic events. I've seen them happen 3 times before in my life. And you don't need a weatherman to tell you which way the wind blowing when that happens. As to a silver squeeze, I am not one of those who believes that there's been an ongoing conspiracy to depress the price of silver over time. I worked for great big financial institutions, and the idea that they would take a negative carry, a short position, over 10 years or 12 years, which affected quarterly cash bonuses, the probability of that occurring is nil. Wouldn't happen. Markets, all markets, are manipulated in the short term, and they're manipulated in whatever direction is easier to manipulate. For 40 years, you have manipulated silver markets down because that was their natural direction. I remember the 1970s when trading desks would manipulate the price of silver up because that was the easiest direction. The manipulation takes place because the futures markets, the paper markets, often trade 200 times the available silver to cover on a daily basis. They're much more liquid. So the game works like this. A short syndicate gets involved over the last 40 years short in the futures market. 6-year duration, 12-month duration, 24-month duration, that kind of thing. And they get what would be for you and I massively short. $2 billion short, $3 billion short, in a market where the nominal value of the positions is $400 billion. And then they borrow $50 or $60 million worth of bullion, and they pound it into the market physically at whatever point in time the market has the least volume.
Right.
And they use the impact of the physical market on the futures market to cover their shorts and pay off their physical loss. I mean, you see it happen time and time and time again.
I
don't think that there's any evidence that supports long-term price manipulation. I think that there's an aggregate of short-term price manipulations. The Eurobond market has been manipulated. The Euro market's been manipulated. The U.S. Treasury market's been manipulated. If you can manipulate markets that are that big, the silver market's a piece of cake. What'll change, Kerry, is that the easiest way to manipulate the market is going to go from down to up. People who are involved in complex hedges in the silver market, I think, are going to get massacred. I think they're in for some truly religious experiences, to the extent that a short position on silver that has been put in place by algorithms that are looking at silver markets over the last 40 years. Those leverage guys are really, truly in for a world of hurt. Long-term capital management worked until it didn't. It was a convergence trade, but the convergence trade wasn't set up for a third standard deviation anomaly. And I think the silver market is going to see a third standard deviation anomaly, which means that the people who are using silver as an unhedged corollary to some economic bet, and they're doing it from algorithms that are based on 40 years of trading history, they aren't prepared for a hiccup, and they're going to get a hiccup. To be honest with you, $35 billion is a lot to you and me, but the notional value of derivatives is more like $5 trillion. I'm not so concerned about that. I'm much more concerned about things like unfunded entitlement liabilities and the imbalance between the nominal and the real interest rates. If you want me to scare your audience, Kerry, I can really truly do that. I'm less concerned about the impact on Wall Street and the derivatives markets by a silver short. I think it'll be, I think there's probably a couple of quantitative hedge funds that'll go broke. Good riddance.
No one cares about them anyway.
Yeah. The derivatives market is truly vast. There are other counterparty scenarios that scare me a lot more. If Moz and Paws in the United States that own high-yield ETFs, junk bond ETFs, get a whiff of the beginnings of a credit crisis like they did in 2008 around real estate, and they go to sell those high-yield ETFs, the ETFs are extremely liquid. They trade billions of dollars a day, but they're comprised of assets that are totally illiquid.
Yes.
If they redeem the ETF and the manager has to sell the bonds and can't, now that's a scenario that's truly scary. Carrie, in shows like yours, where there's live Q&A, I've talked to investors that held high-yield ETFs that didn't understand that the assets were comprised of junk bonds. They just looked at the cover yield, not how the yield was generated. When I was a younger man, I wasn't a young man, but in the 80s, I was pretty active in the high-yield credit market because I understand how to read bond covenants.
Let me answer that in parts, because I think people misunderstand not only how silver behaves, but why it behaves the way it does. My experience, and it's fairly extensive after 5 decades in the resource markets, is that in precious metals bull markets, gold always leads. It's the sentinel. It's the sober money, the capital preservation vehicle. But once gold's momentum attracts the attention of generalist investors, the folks who don't follow Kitco or listen to mining podcasts, then leadership transfers to silver. And that's when things get really exciting. Whether we're at that pivot point right now, I don't know. I suspect we're close. But I do know this. When it happens, you won't need me to tell you. You won't need a weatherman to know which way the wind is blowing. When silver gets hot, it gets volcanic. I've seen it happen 3 times in my life, and it's a sight to behold. These are not subtle transitions. These are market ruptures. Silver doesn't tiptoe, it stampedes. Now, as to whether there's some deep state conspiracy to suppress silver prices, I'm not a subscriber to the tinfoil variety of that argument. I work for large financial institutions. The notion that some trader would take a multi-billion-dollar short position over 10 or 12 years, fully knowing it would negatively impact his quarterly bonus? Laughable. That's not how human incentives work. Wall Street is many things, but it is not long-suffering. That said, manipulation? Of course there's manipulation. All markets are manipulated in the short term. They are manipulated in the direction that is easiest to manipulate. It's about liquidity. For 40 years, silver's been in a downtrend. So when it came time to nudge the market, it was easiest to manipulate it down. That's simply the path of least resistance. I remember the 1970s. In that decade, trading desks were manipulating silver up. Why? Because that was the direction of least resistance. It wasn't ideology, it was convenience. What changes the game is this. The direction of easiest manipulation is changing, from down to up. That's where we are. The short side games are becoming harder to sustain, and the price action is breaking out. You're already seeing these little anomalies where silver gaps up, seemingly without news, and the bid depth disappears. The mechanics of this are pretty straightforward. The futures markets, these paper markets, often trade 200 times the amount of physical silver that actually exists on any given day. 200 times. So if I'm running a short syndicate and I want to profit, here's the playbook. I short the paper market. Let's say I go $2 or $3 billion short, which sounds like a lot until you realize the nominal volume is around $400 billion. Then I borrow $50 or $60 million worth of physical silver, and at the moment of least liquidity, say a Thursday morning at 3 a.m. in London, I dump the physical into the market. That drives down the futures, and I close out my shorts at a profit. The physical loss? Who cares? It's peanuts. That, friends, is how the sausage is made. But what happens when it stops working? Here's where things get interesting. These algorithmic hedge funds that have been operating based on 40 years of downtrend data, they're not ready for what's coming. They've built their risk models assuming silver is just a sleepy metal that never behaves irrationally. So when silver goes non-linear, and it will, these guys are going to get clobbered. Third standard deviation anomaly, wiped off the map. Long-term capital management worked until it didn't. It was a convergence trade. It relied on normal spreads. But when that third deviation event hit, the entire thing collapsed. That's what's coming in silver. Except this time, the people involved are even more leveraged, even more opaque, and even more reliant on models built for a different world. Now let me scare your audience a little more. You think silver derivatives are bad? Try junk bond ETFs. You see, $35 billion in silver derivatives is a lot to you and me, but in the grand casino of finance, it's a pittance. The notional value of derivatives is around $5 trillion. But here's what really keeps me up at night. The mismatch between liquidity in ETFs and the illiquidity of their underlying assets. When Mo and Pa Kettle in Kansas start to get nervous, say there's a headline about a credit crisis, and they try to redeem their high-yield bond ETFs, they'll find something troubling. The ETF itself is liquid. It trades billions of dollars a day. But the bonds it holds, junk, illiquid, sometimes untradeable. If enough redemptions come in, the ETF manager has to sell something. But there's nothing to sell. It's like trying to withdraw water from a dry well. And then we have a situation like 2008, but potentially